Welcome everyone to the Conservation Finance Alliance webinar series. My name is David Myers, the Executive Director of the CFA, and I'm very excited to have Katie Mathias and Ray Victorine, who will be joining us in a little bit, presenting on the Conservation Trust Investment Survey. This is a survey that you probably mostly know that's been going on since 2006, if I'm not mistaken. So we have quite a number of years of this work, and I think that all the funds that are interested in this and the donors find it very, very useful and anticipate the release every year. And so we're happy to say that we just released this 2017 version, which you can find online. And without further ado, I'm going to pass it over to Katie. And please, during the presentation, if you have questions, you can write them down in the chat option and in the chat box, and or just save them for when we get to the question and answer time. And if everyone could please make sure their microphones are muted as we go forward, so that there's no background noise. And over to you, Katie.
Great, David, thank you. And as David mentioned, Ray Victorine will be joining us hopefully in just a few minutes. I plan to present for about 20 minutes, maybe 25, and then move into questions and answers, because I think most of us enjoy this material the most when we can talk about it, and that's an idea. I think a lot of people probably work with I'm just going to give a little bit of context and background in case anyone's joining us who's new to this area. So we worked in 2013 to align the definition of conservation trust funds that we use with the CTIS with the practice standards. And for the most part, the definitions are, there may be a few words here or there that are a little different, but for the most part, we're pretty carefully aligned. And that definition was built on the document that's called the Rapid Review. So CTFs are private, legally independent institutions that provide sustainable funding for biodiversity conservation. We know that not everyone that might be called a CTF is completely legally independent of government, but that's the usually the idea. They work to finance.
Katie, I'm just going to interrupt real quickly. You fade out every once in a while. I think if you're touching your microphone or something like that, that you lose volume, and it takes a while to come back. So
okay.
Just thought you'd know.
Thank you.
Yeah.
I will also just talk slower and hope that that helps. The conservation trust funds also finance protected area management costs, often for an entire national system, and do make grants for conservation and sustainable development initiatives that are outside protected areas. So we see a range of CTFs, some working specifically with PAs, but others that focus on conservation projects that are adjacent to or even completely unrelated to the PAs. They raise and invest funds to make grants to NGOs, to community-based organizations, and often back to the government when we're looking at national protected area systems. They tend to be financing, or always are financing institutions rather than implementers themselves. There is a wide range of practice in terms of conservation trust funds. Some manage a single endowment or a single sinking fund. Others are managing 8, 9, or 10 separate endowments and sinking funds and have governance structures in place for each of those funds. We often hear them called environmental funds. that tends to be the REDLAC funds are prefer to use environmental fund over conservation trust funds. So as you hear that term, they're more or less interchangeable. Globally, we have counted close to 100 conservation trust funds that are in operation or some stage of development. Some of them are conceptual and still in the process of being turned into reality. They're operating on 6 continents in 60 countries, and in aggregate, they're managing about $1.1 billion US in investable assets. A quick background on the CTIS. David mentioned it started in 2006. This is the 11th report. We gather and share data about the investment practices and performance of the conservation trust funds around the world. The report is produced each year by WCS and the CFA in partnership with REDLAC and CAFE, and increasingly with AppNet, the new Asia Pacific network. It's a resource for conservation directors, staff, boards, investment professionals, and most frequently what we hear is that it's a resource for people who are thinking about starting a conservation trust fund and looking for information and data on what's possible, feasible, and likely as they do their planning. We are incredibly grateful to the conservation trust funds for their participation in this process, because that's how we get our data. We can't exist without them. And so I know that it takes time to fill out the documents, to submit the forms, and we are so appreciative of that work. So to move on to some of the data, it's a little hard to remember because it was a year ago and things have gone through some change. But 2017 was a really big investment year. We saw very high equity returns. The S&P 500 was at about almost 21.9%. The MSCI World Index, which is a developed market index, was at 22.4%. We saw emerging markets at over 37% returns. So it was a fairly exciting equity year. We saw growth in the bond market. So the Barclays Capital Aggregate Bond Index was at just over 3.5%. We continued to see cash returns at close to zero. And so, so the feeling in 2017 was fairly exciting. I know that we are now in a market that feels exciting for other reasons, but today we're casting our memory back to that warmer, fuzzier investment feeling. A quick snapshot of the conservation trust funds that participated in the 2017 survey. There were 36 overall. The breakdown on size, about 17%, were over 50 million in assets. And by contrast, 38% had 0 to 10 million in assets. That's US dollar equivalents. Again, about a quarter are in the 20 to $50 million range, and another 17% in the 10 to $20 million range. So we're seeing a fairly wide distribution of asset size, but we're also, I had to create the over $50 million grouping about 2 years ago because we had seen enough CTFs reach that size that it no longer made sense to have a 20 million and up category. We needed to really classify those much larger funds. The geographical distribution, Latin America and Africa in participation were close to the same. The Asia Pacific region has a smaller number of funds, and the European, East European, and Central Asia funds are now representing 9% of the pool of participants. So before I get into the details on the data, I want to clarify some methodology notes because this is an area that is can be really confusing. It's still confusing to me, and I've been doing this for 6 years. We look at 2 types of returns. We do one set of returns that are by organization, which means if a conservation trust fund is managing 8 or 10 separate funds, we will do a weighted average of those returns and look at that organization's return as a whole. That's what we call an organization return. And in a presentation of organizational returns, each conservation trust fund, whether it's one $5 million fund or $100 million organization that has 6 or 8 or 10 different sinking fund and endowments within them, will each count as one data point. But we also look at the returns by the type of fund, where we'll look at each averages of just the endowments, averages of just the sinking funds. There were about 46 endowments that we looked at and 13 sinking funds. And when we're looking at, we will also report overall averages of the fund returns. And that's where we add into the mix a very few number of trust funds that co-invest their endowments in sinking funds and don't break them out when they report them. So it just counts as a combined fund. So I'll try to clarify this as we're looking at the specific slides, but I just wanted to highlight that there's some data that's organization weighted and some organization that's fund only. And both things are interesting. They tell us slightly different pictures. So these were the nominal returns for 2017. And we draw a distinction between the nominal or pre-inflation returns and the real returns, which take inflation into account. The nominal returns are after fee, but again, before inflation. So in the left-hand column, we see the organization weighted returns for each fund, each organization, whether it's, again, a small $5 million single endowment trust fund or a large fund, counts for one. And the distribution there is the 25th percentile is about 6%. The 75th percentile is just under 14%. The mean and median are above 10%. Again, these are nominal returns. When we look just at the endowments, we see a slight decline. The reasoning for that would be that some of those organizations, whether they were a single fund with a really high performance in 2017 or a grouping of funds that had a few high performers, tended to push the organization returns above either the endowment or the sinking funds. So we see the endowments doing fairly well in the 5 to 10% range in most of the clustering. The sinking funds did not as well this year. With a 75th percentile, that's about 6.5%, I think, 7%. When we compare that to some of the external benchmarks, which we provide for context, we're not recommending the use of any specific benchmarks. These are just ones that we've been tracking over the last couple of years. Excuse me for just a second. I'm going to have to move my GoToMeeting control panel so that I can see that half of the slide, and it sometimes messes with my PowerPoint. So, yep, it did. Sorry, just a second. Should be back. So we saw, as I mentioned earlier, that the MSCI World and the S&P 500 were near the max of the CTF returns that we saw. The Capital Aggregate Bond Index was in some cases above some of the minimum returns that we see, and that's been a shift for bond returns recently. So I'm not going to dwell too much on these numbers because they're sort of only interesting in context. So let's keep moving. We look at, sorry, I'm once again going to have to move my control panel. I don't know why it affects my slides. When we look at changes in the nominal fund returns over time, this is just looking at endowment funds in green, sinking funds in red, An overall average in blue, which includes sinking funds, endowments, and those combined funds I mentioned that are not broken out as one or the other. This slide is showing us the compound annual growth rate for the year that ends on the x-axis. So in 2013, the number reported in the 2013 is the 5-year average that started in 2009. So if you'd invested in 2009, over that 5-year period, you'd have about a 6% return by the end of 2013. We see some pretty high spikes around 2011, but on average, we're seeing 5-year average growth around returns around 4 to 5%. And interestingly, in the last 3 or 4 years, those averages have started meeting up. So there's not as much divergence between sinking funds and endowments. When we're talking about the types of investment that conservation trust funds are doing, it's long-term investment. It's expected to, at least in the case of endowments, typically exist in perpetuity, which should mean forever, although in a practical basis, most of the trust funds have not existed more than 25, 26 years. So it's kind of hard to conceive of longer periods of time from a planning perspective, but we think about perpetual investment for the endowments. And because of that, inflation is a critical consideration. How do we make sure that the investments are going to have the same economic value 5, 10, 15, 20 years from now, multiple generations from now? And considering inflation is the only way to ensure that that is happening. So the blue bars here, and again, this is looking at endowments, sinking funds, and then endowment, sinking funds, and combined funds together in that first column on the left. The blue bars are showing the nominal returns, and the red bars are showing the real returns after inflation has been taken out. And we see a drop of about, on average, 2.5–3%. Because the returns were strong last year, 6.4% real returns is pretty great. Again, after inflation's been considered. Right, there we go. In their investment practices, the trust funds employ a number of diversification strategies. So I'm moving on to talk about what investment policies are the funds using, which are the CTFs. One of the diversification strategies is to diversify on currency. We look at essentially 7 different categories: trust funds that are investing in their own domestic currency or in their domestic currency with some others included. Those that are primarily in euro. We do have a category for euro and others, although we didn't have any respondents in that category this year. Those that are in US dollars with a mix of others, and then those that are really diverse are invested in a variety of currencies. We see that when we look at the returns, and these are nominal returns again, we look at the impact of, when we look at the returns by currency, they're ranging from domestic currencies that on average had negative returns when mixed with others, 4.5% returns for just domestic currencies. And these are the currencies in which the trust funds are spending. So the currency of their home country in which they're spending on programs. Euro returns at just over 5%. The plain US dollar returns at just over 7%, but US dollars mixed with others at 12.5%. The pure mix was just barely over 0. Another diversification strategy, probably the main one, is diversify by asset type, where we look at equities, fixed income, cash, alternative strategies, which includes private equity, hedge funds, commodities, and real estate, some subordinated debt, and other private equity, and some other private equity strategies. Those are all falling under alternatives. Other usually refers to not classified or not clarified in some way. So what we've been seeing over time is that there is a heavy weighting towards fixed income and cash. The averages are often over 50% in most years. The last couple years, the fixed income and cash weightings have been over 50%. And equities are usually running at 25 to barely 30% of the overall portfolio allocation. Alternatives are a relatively small percentage. The highest we've seen was in 2011, but for the most part, it's running at under 10% of portfolios. And then another form of diversification that we look at is by geography, and that's where are the underlying assets based? Are people buying Asian equities? Are they buying African bonds? Are they buying European private equity strategies? This is looking specifically at trying to get a sense of whether people tend to focus their investments in the region where they're based or whether they're diversifying more globally. So when we look at the Asia Pacific region, pardon me, it tends to have, sorry, my slide, I just moved that GoToMeeting thing and it did it again. Asia Pacific, for example, has a high percentage of its own country. The Latin American Caribbean, also a high percentage of its own country. But on the whole, we're actually seeing some fairly good global diversification. The regional returns, these are nominal returns, not adjusting for inflation. Trust funds from the Africa region had, oh, I'm sorry, I beg your pardon, those are real returns. Real returns of 6.7%. The Asia Pacific funds had real returns of just over 10%. And Latin American Caribbean funds real returns of 6% for 2017. Sorry, I'm having trouble getting the slide to advance. There we go. So one of the things we started to look at this year is if we look at currency and geographic region, geographic origin of the assets and asset allocation, how diversified are the participants in the CTIS? We found that 58% of the participants were well diversified. They had a mix of asset classes. They were diversifying on currency, which means they, in this case, they were including a hard currency as well as their, if their spending currency was not a hard currency. And they had a global mix of assets, so they were looking around the world for diversification. There's another 32% that are partially diversified. So they're either in a single asset class, bonds, but they're diversified within it, looking at corporate and a combination of corporate and government bonds, and have a global base of products. So they're not So while they may be in a single asset, it's a well-diversified asset class. Or they're invested domestically in their domestic currency, so they don't necessarily have currency protection or currency hedging, but they have a global mix of different assets and different asset classes. There's another 10% that are not well diversified. They're either in a single asset class or they're using domestic investment products and they are using their domestic currency. Those are the ones that are more concerning. So one of the plans that we have in place, and I'll talk more about this in a minute, is to do a 10-year study because we have 10 years of CTIS data. Excuse me, just one second. Jeannie, could you email or Skype Ray with the login information? He just texted me and I can't text him back and keep talking.
Yeah, I'll send it right now.
Thank you. So we're going to look at taking our 10 or 11 years of data, look at which asset allocations have been the most effective over a 10-year period. And part of that is right now I can identify that there are 10% of CTFs that are not well diversified, but I can't tell you if, as I would hypothesize, their returns have been particularly volatile over the last 10 years and particularly subject to economic shocks. So what we're planning to do with that 10-year study, which we'll be working on in first quarter of 2019, is to identify what conclusions we can draw looking at that asset allocation data and attach performance data to it. So building on that, we did do part of what sort of keyed up that idea of doing a 10-year study is we did a sort of a quick analysis of some of the, based on some of the data we have, to look at the relationship between asset allocation and performance. And we based that on the premise that endowments are investing to preserve purchasing power for future generations by taking into consideration inflation, while at the same time generating returns to pay for biodiversity conservation and to grow their capital base. So the constant push-pull for endowment governance is the trade-off between the current need to pay for current biodiversity conservation and the recognition that these assets also need to pay for continued conservation 1 or 2 generations from now. And how do you invest to make that trade-off? We assumed that endowments are thinking about both, and that in order to consider future generations, that they need to take inflation into consideration. Recognizing the investment strategies are going to depend on a lot of things, a lot of considerations. So we're not assuming that it's simple, because it's not. When we looked at endowments over 5 years, and we haven't added in 2017 yet to this short additional supplemental study, but that will be the work of next year to do a really comprehensive look at this. We saw real returns averaging about, when we look at the average over time, it's about 2.5%. So ranging from a negative almost 4% in 2015 to 5.9 in 2012. So we were curious to know, what does that mean on a practical basis? So if we took a conservation trust fund that had 10 million euros at the start of 2012 and was spending 2.5%, that's a little low, by the way, but that's what we used for this calculation. If we use the average returns that were reported on the previous slide, and we assume that the inflation rate was being reinvested each year to cover capital, then that average conservation trust fund over that 5-year period would have a balance of 11.2 million euros at the end of 2006. That's after having spent 1.35 million for biodiversity conservation over that 5-year period. So I put that out there as an analysis. I think it's for the Conservation Trust Fund community to discuss and debate. Are we good with that? Is that the level of investment in conservation that we're hoping to see? Could we do better? And if we did better, would we be taking on more risk than we're comfortable with? These are the discussions to have. What I'm seeing when I look at some of the challenges that trust fund managers are experiencing in their investment strategies, we see a pretty high allocation to cash and fixed income, which does not generates income in the current year, but it doesn't grow the asset base in a way that will cover inflation over time. And in conversations, what I'm hearing is that there is a sense of risk associated with the equity markets that cause trust funds to not be comfortable with the global equity markets. But on the flip side, there is another risk, which is that you won't generate enough returns to fulfill your mission over time. So there's two sides to that risk equation, which is a challenging one, I think. What we also see out of the way that manifests itself is a desire for local investment, which sometimes results in what are actually higher risk, higher volatility domestic market products. So instead of hedging risk by diversifying, it's throwing, metaphorically, all the eggs in one basket in high inflation, high volatility, typically low-rated bond products. So, as I mentioned, we're gonna take on a longer-term project, but when we looked at just the top 5 performers in 2014, 15, and 16, we pulled out the funds 5 CTFs that had the highest real returns in 2 or 3 of those years. The asset allocation for those funds was 60% when they looked at equities and alternatives together, about a quarter in fixed income, and only about 13% in cash, recognizing that conservation trust funds obviously have to keep money in cash to be able to meet current spending obligations. So I have seen some allocations that are going as low as like 2 or 3% in cash. But I think the 13% average is similar to what I've been seeing lately. So when we look at those top performers and how they returned over this 5-year period, in 2006, so we removed the identifiers. These are funds from around the world. They're not from any specific region. They, again, were the 5 funds that had the highest real returns in 2 or 3 of the 3 years I looked at. Part of what we're looking at is how they do. Part of also what we're looking at is how well do they manage volatility? So do they have predictability in their returns? I'm a little behind time, so I'm going to pick up the pace a bit. When we look at the asset allocation, again, the equities plus alternatives are in the 50 to 60% range for most of them. If there's a gap, it means I didn't have data for that fund for that year. If they, and then we see cash and fixed income at smaller, like 30 to 40%. So, Ray, are you on? I was going to kick it to you at this point, but if not, I'll keep going. Not hearing anything, I'm going to keep moving.
Keep going. I just joined, Katie, so why don't you keep going?
I'll keep going. So a few of the general observations and conclusions that we've drawn. Every year, Greg Alexander, who's a global investor in the hedge fund world, writes our foreword, and he has been pushing persistently to encourage trust funds to consider the importance of equities in their asset allocation, recognizing that that's the only asset class that's going to generate enough growth over time to ensure that the investment base is there in the future, not just today. We are seeing that the CTF portfolios on average, and again, there are certainly many exceptions, but on average, there is still a heavy weighting to fixed income and cash. And as authors of the study, it concerns us that there may not be the investment base there in the future to continue supporting biodiversity conservation. On the average, we've been seeing 2.5% real returns over the last 5 years. The trust funds are telling us that they're spending 3 to 3.5% each year on average. So that tells us, again, at the average, that the endowments have not been investing to cover, recapitalize and to cover inflation. That might be a strategic decision to prioritize current spending. As I mentioned earlier, there is this constant tension between how do you meet current spending needs in the face of pressing threats to biodiversity conservation versus ensuring the investment assets of the endowments are there in the future. I think there are also some conversations happening about whether there should be some flexibility in whether all endowment capital has to be preserved in perpetuity or whether there can be dipping into the corpus. Our concern is that in some cases, we're not sure if it is a strategic decision to prioritize spending or just that inflation hasn't been considered in the investment strategy. What we're seeing is that the performers who have the highest real returns over time are allocating about 60% of their portfolios to equities and alternatives. And with that, I would like to stop talking and invite the discussion and open it up to questions.
Katie, this is Brina from BirdLife International. Can you hear me?
Yes, hi.
Hi. I am curious. I just kind of dipped back into the report to see if I could find any more. I'm interested in what the alternatives category includes, and if you have any kind of interesting anecdotes or sort of any insight into what those alternatives are and how they do.
Yes. So alternatives is a strange catch-all for strategies that don't neatly fit into equities, fixed income, or cash. So it includes private equity strategies, hedge funds, commodities, so buying gold and oil, and typically in those cases it's buying funds containing futures of gold and oil, not and then real estate. And for the trust funds, real estate can mean actually physically holding real estate, usually in their home countries, in the form of either their own offices or other real estate that they've invested in, either as solely as an investment to generate income, or to save, in the cases of their office buildings, to save expenses. It can also include real estate that they purchase for conservation purposes. That's a teeny tiny percent at this point of trust funds who are doing that. But for example, hedge funds and private equities tend to have really both high returns and high volatility. They also tend to have two particular challenges. One is that they can lock up assets over a long period of time, so they're not liquid and they're not. They require being willing to hold for 5, 10, sometimes 15 years before you see the return. The other challenge that they have is that they're not always accessible to smaller investors. And so the highest performing hedge funds are really only open to mega high profile investors, particularly large institutional investors. What the conservation trust funds are usually buying into is a hedge fund, fund of funds, sometimes a hedge fund index. They may or may not have the same lockup periods that you would if you bought directly into a hedge fund, again, depending on how the funds they're buying into are structured. We tend to see, for the most part, we tend to see high returns in those asset classes. I mean, in particularly when we look at hedge funds and private equity, but we also see volatility because when those strategies do well, they do very well, but when they do poorly, they do very poorly. So they can have a role in the portfolios, but they're never going to be a huge percentage of the portfolio just because of the risk attached to them.
Great, thank you.
Okay, do we have some other questions for Katie? Everyone just unmute yourself if you'd like.
Quick comment.
Okay, Ray.
Yeah, I think one of the things that, that important to keep in mind, we look at the market this year and see how much volatility there is. I think that does create a certain amount of fear. And so really the idea is that having funds to keep a long-term view and not kind of get nervous for 1 year's performance. The idea of having 3-year and 5-year investment sort of horizons often helps a lot. We've also in the study have been trying to just track what a hypothetical portfolio, which was looking at sort of a funds that like an index of 60% equities and 40% fixed income, and as a way to look at what if you just did something like that and how would that play out. And in 2017 it was almost like a 15% return. So I think we're going to try to track some of that too to see how it goes over time, so that get an idea of that the fact there is volatility, but how does that play out in 3 years or 5 years in terms of what the fund is trying to do, given that the funds really are needing to take a long-term view, long-term perspective. And so I just wanted to make that comment.
I have another question if no one else does. Sorry, I'm wondering if you've looked at, and this might be in the report, like if you've looked at who actually has say over how the funds are investing, and kind of how that, if that impacts the different investment strategies, like if it's the actual CTF team or if they outsource that, and how that impacts things.
Yes, so we actually do collect data on that, and it is in the report. I don't put it in the presentation only for time. What we ask is how many are making all the decisions internally, how many are outsourcing, and how many are doing a mix. And we look at 4 key functions of the investment management process. One is the upfront process of setting strategy and portfolio allocation. The second is making the asset allocate. Sorry, one is the upfront strategy process. The second is portfolio allocation. The third is actually determining which specific products to buy, the asset management. And then we ask about brokerage. For the most part, everybody is going to have to outsource brokerage because you need if you're doing anything other than bank products, you need a registered broker. That being said, we do have some conservation trust funds who are investing in bank products. And for those, they are not outsourcing brokerage to anyone. And by bank products, I mean what are effectively CDs or 3-month bond products, short-term investments that a retail bank can sell. And then the last is the portfolio review, looking back at how the managers performed and doing the how are the managers that you hired doing, and how did your performance compare to your targets and expectations. And the trust funds are a little bit over the map on that. I would say that for the most part, they are outsourcing asset allocation, so they're not making asset management, which is to say they are hiring professionals to make specific purchase decisions about which types of funds or which types of bonds or which types of equities they're going to buy. A large number of them, I would say they're split on whether they're doing the upfront strategy and the portfolio review, so the front end and the back end of the process, whether they're doing that in-house with their investment committee or whether they're outsourcing it to consultants. And I'm sorry, I don't have the specific percentages, but they are in sort of the last third of the report.
Great, thank you.
Katie, this is David. I have a question. As the funds get bigger, does that change their investment strategies at all? And have you looked at size of the funds compared to their returns? Are they taking more risks? Are they, has anything like that showing up?
I not every year, but so maybe every other year, I run regressions on the return data against a number of factors, including the size of the fund, and I can't show any relationship. That's because the sample size is so small. But even when I eyeball it, as they get larger, they're much more likely to be using external professionals. But I would also say that's not always a function of size. Sometimes it's a function of the newer funds, the most recently created funds, and certainly the funds that have been created since the practice standards came out are also more likely to use external professionals to do more of the process, where the investment committee is making governance decisions and relying on the expertise of outside professionals. I don't necessarily see that they're taking on more risk. I think that the larger funds are really well diversified globally. So where they're taking on risk, they're doing it as part of an intentional strategy. And certainly the larger funds have access to more investment products and the ability to negotiate for fees. I will add to that, particularly because I think we have several Nature Trust Alliance folks on, and if you weren't able to attend the webinar that Nature Trust Alliance did a few weeks ago, there's a recording up on the the CFA website. One of the things that we are seeing is a growing trend towards pooling, where several conservation trust funds pool together to get access to better investment products and to negotiate their fees down just based on size. And I think that's been an interesting trend. I'll be interested in continued conversations about whether there are more opportunities for that to happen.
Great, thanks, Katie. Okay, any other questions about the results or strategies? James had a question about one of the results, which was quite kind of technical, but it had to do with the overall, comparing the overall to the endowments and sinking funds, and
right,
just
now I can see it. Overall 2017 performance, which seems higher than right. So depending, James, on which slide. So James's question was overall 2017 performance is higher than endowments or sinking funds, and that issue has been flagged a few times because it is anomalous. There are one or two trust funds that combine their data, their endowments and their sinking funds together, and so I track those as combined funds as opposed to just endowments or just sinking funds. So those overall returns are sinking funds, endowments, and combined funds. And in 2017, the combined fund return, which is in the overall, but not in either endowment or sinking fund, the combined fund returns happen to be high enough to skew the overall return, the overall average above either endowment or sinking fund. I agree, it looks really weird, and I think it is anomalous to this year that those one or two combined funds just happen to have really high returns. James has also flagged the need to invest in real assets, and includes the ownership of entrepreneurial businesses as well as equities. Jim has a question. To what extent is the lack of international diversification due to the fact that the trust fund was created through a debt swap that required investing proceeds of the swap domestically, or involved in the issuance of bonds as part of the swap and local currency that tie the hands of fund managers? Yes, that is definitely an issue, and one that I think is important to talk about. So just by way of elaboration, quite a few of the trust funds were created through debt swaps with local currency. In a lot of cases, that meant either the expectation that they were going to invest in domestic products, divestment in local investment opportunities, or they're legally prohibited from moving that currency offshore into offshore accounts. I think that does tie the hands of some funds. But what I have also heard in conversation, and in fact in conversation with some donors, is that the perception by the managers, the investment committees of those funds, of the constraints may not be what the donors either intended or want. And so there could still be some government constraints there. But the donor constraints are not necessarily what, there's room for conversation, I guess is how I will put it. And so James Moneycurl, who's on this, I think still on the call, and I have been doing an investment management workshop 4 conservation trust funds. We've done it with 4 conservation trust fund boards, one that was a single board and 1 workshop that was a group of participants from 3 boards. And we've done it at Red Lac as an open enrollment. And we use that, it's to build expertise in investment management for executive directors, staff, and board members. But we use that also as an opportunity to encourage a conversation about what constraints do you have on your portfolio, and how many of them still exist, or how many of them haven't been re-examined. And when we ask people for examples, a lot of funds haven't looked at their investment policies in a pretty long time. They're not looking at them every 2 or 3 years. They may not have looked at them in 5, 6, or 7 years, sometimes since founding. And so we have been encouraging that governance process of regular review of the policy, regular revisiting and testing. What are the constraints that you really have, and can those be challenged, or are your hands really tied? Hopefully that answered Jim's question. I was reading it off the chat square.
Okay, thanks, Katie. We're just about the hour mark here, so if anyone has maybe one last question before we thank everyone. And before we do, I just wanted to thank our donors and financial supporters, the FFEM and the MAVA Foundation, for supporting this work, and thank also, of course, Red Lac Cafe and AppNet for their support and collaboration, and all the funds that contributed excellent information to the analysis. So one last question before we sign off. Okay, well, the document is up online, and it's really great. And so I want to thank Katie and Ray for all the work that they've put into this, and thank you for the presentation, and thank you all for participating. And we look forward to speaking with you all again soon.
Thanks, everybody. Thanks, David.
Thank you.
Thanks. Bye-bye.
Good morning.